Fannie and Freddie weren't the only entities in Washington pushing for looser lending requirements. Government agencies of various kinds were pressuring lenders into making riskier loans in the name of racial equality. Not wanting to be on the wrong end of lawsuits demanding hundreds of millions in damages, these lenders did as they were told. Now, a lot of times the lenders also would have gone along with it to avoid the lawsuits because in many cases they'll settle out of court, which means they're still going to be paying something even if they believe they haven't done anything wrong. Or the other option is to take it to trial, and even if you win, you have to pay lawyers a lot of money. So sometimes it's just cheaper to settle than to pay the lawyers. Charges of racial discrimination in lending helped spur this rush. In 1992, a study by the Federal Reserve Bank of Boston claimed to find evidence that even allowing for differences in credit worthiness, minority applicants were still getting mortgage loans at lower rates than whites. So even if they had the qualifications to get these loans, the Boston Fed found that they still weren't getting them, and they believed it was because of racial biases. The study was widely hailed as definitive by those who wanted to believe its conclusions, that American banks were guilty of discrimination against blacks and Hispanics, though not against Asians, who got mortgage loans at even higher rates than whites, and should be forced to make credit more widely available to people in inner city neighborhoods. Evidence later surfaced exposing the sloppiness of the study and showing that no evidence of discrimination was found when errors in the data were corrected. But it was too late. The pressure groups had their bludgeon and intended to use it. The problem that we often have with bad information is that even if a correction or a retraction is made, most people who saw the original story or saw the original report didn't see the retraction or the correction and never knew that the study was wrong to begin with. We see this in this study. We also see this in newspaper articles as well. The Community Reinvestment Act, or the CRA, which was a Jimmy Carter-era law that was given new life by the Clinton administration, has received a great deal of attention and criticism since the housing bust began. Jimmy Carter won the presidential election of 1976 and served as president between the years 1977 and 1981. That law opened banks up to crushing discrimination suits if they did not lend to minorities in numbers high enough to satisfy the authorities. But it wasn't just the CRA that was pushing lower lending standards. It was the entire political establishment. Three members of the Board of Governors of the Federal Reserve System, Robert Avery, Kenneth P. Brevoort, and Glenn Canner, authored a study that showed that the Boston Fed report from 1992 was incorrect. This report came out in 2009. It says the normalized credit scores used in this paper don't precisely correspond to score thresholds used by lenders to segment borrowers by risk grade. So the percentages that they're using or the threshold that they're using isn't exactly what the banks will use, but it's close enough that they can make some distinctions and they can make some conclusions. It says roughly, though, a score in the top 60% of the distribution of 40 or more would place the individual in the prime market. These are the best possible prices for a mortgage. Remember that prices, when you're talking about a mortgage, indicate the interest rate. A score from the low 20s to high 30s would place the individual in the near prime market, where mortgage interest rates would be 1 to 2 percentage points above those in the prime market. And then a score below 20 would place the individual in the subprime market, which means an interest rate more than 2 or 3 percentage points above the prime. Again, the reason why subprime mortgages and near prime mortgages have higher interest rates than prime mortgages is simply because the borrower is more likely to default on their loan. The bank wants to get as much money from you as quickly as possible, as quickly as they can, in order to ensure that their losses are going to be minimized. So against this backdrop, differences in the distributions of credit scores among racial and ethnic groups are striking. The mean trans risk score for Asians is 54.8. For non-Hispanic whites is 54.0. for Hispanics 38.2%, and for blacks 25.6%. More than one half of all blacks have scored in the subprime range. Less than one quarter are in the prime range. On the other hand, less than one-fifth of non-Hispanic whites have scores in the subprime range, and over 65% are prime. When loan performance is plotted against score for each score and performance measure, the general shapes of the curves are similar across demographic groups. However, the performance curves are not identical. The curves for blacks are consistently above the curves for other groups. So what this means is that if you have a white person who is in the subprime market, and there's a 30% chance that people in the subprime market are going to default, then you would see 30% of whites in the subprime market defaulting. What they found was that for the black cohort, that number was consistently higher than where it should be. Again, this is a study, or this is a paper that was written to try to refute the conclusions of that 1992 Boston Fed study, which said that banks were lending less to minorities because of race rather than because of their ability to pay off that mortgage in the future. And according to the University of Texas's Stan Leibowitz, one thing a scan of the housing literature from 1990 until 2006 will not yield is any suggestion that perhaps these weaker lending standards that every government agency involved with housing tried to advance, that Congress tried to advance, that the presidency tried to advance, that the GSEs tried to advance, and with which the penitent banks initially went along and eventually supported with enthusiasm, might lead to high defaults, particularly if housing prices should stop rising. Shortly after its discrimination study was published, the Boston Fed also released a manual for banks on non-discriminatory mortgage lending. It explained that banks would have trouble attracting business from minority customers if its lending criteria contained arbitrary or unreasonable measures of credit worthiness. We can safely assume that banks did not need to be told that arbitrary or unreasonable measures of credit worthiness were bad for the banking business. What the Boston Fed really meant, of course, was that the bank standards were clearly arbitrary or unreasonable if minority customers were not receiving a significant percentage of the bank's loans. Remember again that banks had all of these standards in place to protect themselves from defaults. Naturally, banks did what government regulators wanted them to do. Banks began to loosen lending standards, says Leibowitz, and loosen to the cheers of the politicians, regulators, and GSEs. Bear Stearns, a major underwriter of mortgage-backed securities, argued for the soundness of these mortgages on the same Orwellian grounds as the Boston Fed. The credit rating of a borrower shouldn't be so important, that their literature explained. CRA loans do not fit neatly into the standard credit score framework, and so on through the whole roster of traditional lending standards. In the face of the housing meltdown, supporters of the CRA try to claim that since the act applied only to depository institutions, banks such as Bank of America, and that most of the unsound mortgage lending took place outside such institutions, more specialized mortgage lenders such as Countrywide, the CRA was exonerated from blame. It should be noted that Countrywide's toxic assets were eventually bought up by Bank of America. The rest of the manual was filled with the same kind of politically correct doublespeak about credit history, down payments, and traditional sources of income, all of which were presented as dispensable obstacles in the way of increased homeownership among society's least advantaged. Naturally, banks did what government regulators wanted them to do. Banks began to soften. What they didn't say was that the same cavalier approach to risk assessment that informed the CRA pervaded the whole mortgage lending arena. thanks to the other agencies that push the same destructive loose lending strategy on all American financial institutions: Fannie and Freddie, the Department of Housing and Urban Development, more on which below, the Federal Reserve, and others, as well as additional legislation like the Equal Credit Opportunity Act. Henry Cisneros, Bill Clinton's first Secretary of the Department of Housing and Urban Development, or HUD, loosened lending restrictions both while in government and in his own ventures in the private sector to make it possible for people to buy houses who would not have qualified for mortgage loans in the past. He became a developer himself, joining with KB Home, on whose board he served, to build some 428 homes for low-income buyers in the Lago Vista development in San Antonio. But even Cisneros had to admit that whatever his good intentions, people came to homeownership who should not have been homeowners. The New York Times, which sympathizes with his politics, says Cisneros encouraged the unprepared to buy homes, part of a broad national trend with dire economic consequences. He reflects often on his role in the debacle, he says, which has changed homeownership from something that secured a place in the middle class to something that is ejecting people from it. I've been waiting for someone to put all the blame at my doorstep, he says, lightly, but with a bit of worry too. Cisneros is the very model of the public-spirited advocate for the little guy whose paternal oversight is supposed to protect us from the ravages of the free market, and in whom we are expected to place our confidence in the future when free market capitalism will be more heavily regulated. What that last sentence means is that Cisneros is the kind of guy who will be an official in government when the government imposes new regulations on the free market or on individual industries or businesses within the free market, because the free market supposedly failed during the Great Recession. Cisneros personified the federal government's ambition to expand homeownership, which by his own admission meant lowering lending standards and qualifying people for mortgages who would not have qualified in the past. And yet Cisneros sounded no warnings at all about the mortgage market and did nothing to discourage subprime lending when he returned to the private sector. His own development company, American City Vista, partnered with KB, where he already served on the board, right alongside James A. Johnson, former Fannie Mae CEO. Fannie guaranteed many of the mortgages in the KB City Vista orbit. Fannie's top client was Countrywide. Cisneros served on that board as well and sat by in silence as Countrywide vigorously pushed subprime mortgages. There can be little doubt that Cisneros supported the expansion of subprimes. How else, after all, could his ambitious plans for expanding homeownership have been achieved? Again, subprime mortgages were available to people who would not have normally qualified for prime mortgages. Again, not such a great idea, because in a lot of cases, these are people who should not have been homeowners to begin with. One of the things that you need to understand is that there's nothing wrong with renting. Renting is something that is done. There's nothing wrong with renting. Renting is something you do when you don't have the money to put down a large down payment on a house. Now, you might think that you're throwing away money, but you have the opportunity to have somebody fix any problems that you have in the apartment. You have the ability to put money away and save for a down payment in the future. There's a lot of things that come along with homeownership that you may not necessarily understand, and for a lot of people, the better choice is to rent at certain points in their lives. Victor Ramirez, who bought a home in Lago Vista in 2002, told the Times, "I was a student making $17,000 a year. My wife was between jobs. In retrospect, how in hell did we qualify? Most residents," he says, "were duped into believing it was easier than it was. The attitude was, sign here, don't read the fine print." Ramirez wouldn't go so far as to say people were victimized. "We were definitely willing victims," he admitted. Now, a willing victim is somebody who is taken advantage of, but they go into the entire situation as a willing participant. They are an active participant in whatever is happening. As for more regulation as the solution, as if regulators could forcibly prevent people from taking out foolish home equity loans, for instance, Cisneros isn't sure how effective it could be. I'm not sure you can regulate when we're talking about an entire nation of 300 million people and this behavior becomes viral. If anything needs to be regulated, it's the Federal Reserve's credit creation powers, which give legs to frenzies like the housing bubble. But in his interview with the New York Times, Cisneros followed the rules. The Fed was never mentioned. Andrew Cuomo, who also served as HUD secretary under Bill Clinton, spoke with delight after a victorious discrimination settlement with AccuBank Mortgage that forced it to make loans on what the secretary admitted was an affirmative action basis. The institution would take a greater risk on these mortgages. Yes. Give families mortgages who they would not have given otherwise. Yes. They would not have qualified but for this affirmative action on the part of the bank. Yes. Lending that amount, $2.1 billion in mortgages, which will be a higher risk, and I'm sure that there will be a higher default rate on those mortgages than on the rest of the portfolio. So Secretary Cuomo was comfortable with forcing a bank to expose itself to more defaults, and isn't that what matters? Liberals have argued that unscrupulous lenders dishonestly force subprime mortgages with unfavorable or complicated terms on helpless and uneducated borrowers, and conservatives have argued that political pressure forced banks to make more of such loans. There is indeed some anecdotal evidence for the liberals' case, as we saw in the case of one of the people they themselves admire, Henry Cisneros. The conservatives have a strong case. Left-wing groups like Econ blocked drive-up lanes and made business impossible for banks until they surrendered to demands that they make billions in loans they wouldn't have otherwise made. This private intimidation, coupled with a campaign to lower lending standards that pervaded all levels of government, helped to steer so much of the new money the Fed was creating into the housing market, thereby feeding the housing bubble.